prepared? When it comes to how reverse mortgage loans are originated, a line has been drawn in the sand. That is March 2nd, 2015. In 3 short weeks, the long-awaited or dreaded financial assessment goes into effect, forever changing the way that HECM loans are qualified and originated. This is a game changer. The road leading up to the financial assessment has been a bumpy one. With HUD signaling an upcoming assessment, MetLife took the first leap by launching their own financial assessment company-wide back in November 2011. The resulting confusion and broker redirection of loans to other lenders without an assessment and a lack of industry-wide adoption led MetLife to reverse course and suspend the assessment in short order. After this false start and a lack of industry-wide financial assessment guidelines, we all waited patiently for the official word. And there were several hints in the past that the assessment was coming soon, but the policy was inevitably delayed for several more years. That is, until now. Misgivings aside, the financial assessment will extract its costs from lenders in both time and money. With clear guidelines now published by HUD, comes the task of training originators, underwriters, and servicers. Sherry Appanay, Chief Sales Officer at Urban Financial of America, said this: "Training is a key area where we have dedicated considerable effort for retail, wholesale, and operations. Ensuring our teams and partners are best prepared with knowledge of the requirements and understanding of the process is our goal. Lenders industry-wide will not only face the task of training their teams, but adequately staffing in preparation for the assessment. The financial assessment demands additional time in processing and underwriting, and many lenders are adding operational staff to absorb this impact. AAG is requiring that its retail and wholesale operations teams to complete mandatory training in preparation of the March 2nd deadline. Now, beyond the sheer mathematical requirements of the assessment are the subjective extenuating circumstances and compensating factors. And this is where we can expect lenders to have varying guidelines, overlays, and approaches to these more evaluative factors. Paul Fiore, who is Executive Vice President of Retail Lending at AAG, said, "We believe the industry as a whole will be challenged by how it interprets the mortgagee letter as it relates to extenuating circumstances and compensating factors for its reverse mortgage clients, and where those scenarios fit in the loan approval process." Now, indeed, challenges lay ahead, and maintaining momentum in the midst of change is difficult. "It's hard to change the tires while the car is moving," said David Entrican, Chief Operating Officer and Chief Credit Officer at Retirement Funding Solutions. Well said. RFS's advantage is their small sales team as a newly launched reverse mortgage lender, and that gives them an advantage in adopting more quickly to the new guidelines. Now, regardless, our approach, sales, marketing, and origination strategies will be forever changed. Now, how have you and your lender prepared for the financial assessment? Share your inputs and comments in the section below, and have a great week.